So first of all, the entire core of the concept behind corporate valuation is that we would like to see the present value of the expected cash flows from the future. So how much money can the company make? Because one option could be that, okay, let's take all the assets and let's remove all the assets which can, so let's imagine that we are eliminating or liquidating all the assets, so we are converting everything to cash, and then we are repaying all debt, so all the liabilities are removed from this cash, and then the remaining money should be the value of the company, so the equity. But the problem is that usually we are not able to convert all the assets immediately to cash, and practically we are using the assets to generate funds on the long run. So even if we would like to define the value of the assets, still it would require the definition of their cash flow making ability. So we are not much ahead. That's why present value of the cash flow and discounted cash flow analysis can be assumed to be much more developed. The problem is obviously that we need a timeline ahead, so we have to imagine what will happen with the company in the next 5 years, so we need reliable business plan. This is what we prepared last time, so I was able to change the product, and this product change had an influence on the revenue making capability of the company. Okay, it had no influence, but it had the potential to have an influence, but I was able to cut costs at least due to refurbished vehicles. And at the end of the day, this is the workflow here. So first of all, we have to define the free cash flow. So without any discounting, let's see what is happening in the first year, second year, and so on until the 5th year, to determine that what is the free cash flow here. So yeah, obviously we have to start with the earnings before interest and taxes. So from the profit and loss statement, we need the data from here. So after taking all the revenues, after deducting all the costs, and it can be a good start. Just we know that we have to correct it in many ways, because first of all, depreciation is an artificial cost. So we don't have to pay it out, it's just preparing the company that in the future they have to renew their assets, because these assets will be exhausted, or they will be old, or need to be replaced. So that's why in terms of valuation we have to put them back into the equation. And also we have to think about taxes, so gained interest, paid interest, multiplied by the corporate income tax ratio must be considered, and also floating capital is necessary to include it, so the difference between current assets and current liabilities, so short-term assets, short-term liabilities must be considered here. In the case of this simulation, this is the hardest thing, because yes, we have some kind of balance sheet, so that's why we can say that what are the current liabilities. But as you can see, this thing is not changing dynamically, so this is highly constant, so it's not reflecting what is happening with the company when we are scaling up its processes, or when we are changing the underlying product. So this thing is a weak part of the entire valuation. And also we have this current asset, loan and receivables. we have no idea how it's generated. So because the problem with Ariane Space, among many things, is that it's completely owned by two parent companies. So that's why. So this is just an outsourced subsidiary where they are focusing only on one profit center activity, just launching stuff into space. But this is not a standalone. Doesn't have a complete autonomy. I think so. So this loan and receivable can be towards the main partners, but the main business partner is European Space Agency or some other business partners. So yeah, it's hard to determine what is happening here. So inventories, also we have no idea what is this. Usually when we are doing any kind of valuation, if we don't have any kind of field or corporate level assessment, when we can visit the company and we can check that actually what is inside inventories, we can just see these raw numbers. So we have to assume that this is also constant, or it's hard to model. So at the end of the day, we can see that current liabilities, current assets are a weak point. Also, other. Okay, I can understand it that it's easier to define or determine things in the other category. Just usually we should exclude them from the valuation procedure because this is a highly unknown feature, and in many cases it can be important or less important. So we should skip that from the valuation at the end of the day. So we can see here current assets, short-term liabilities. So from current assets, I deliberately removed this component here because it would increase current assets so much that it would bias everything from the game. So only inventories and cash was kept here. In the case of current liabilities, this is highly a constant, so we don't have so many things here. Because if I'm including the long-term or short-term lending to some unknown entities, then the floating capital will explode, and we would have a higher magnitude of free cash flow, so it would bias the model upwards, even doing anything. So I think this one is much more reliable. So in the case of the free cash flow, we have to take EBIT minus taxes plus depreciation plus the floating capital, and after that we can have the free cash flow for each years. And now we can see that how the profitability of the company increases, and also how the cash reserve of the company increases, because in the current asset it's counted. So it's not just annual cash generation, but also cash reserve is accepted in this kind of equation. You can ask the question that one thing is highly missing from here, and these are the intangibles. So, okay, we are developing a rocket, so there must be some kind of know-how behind this, because it's able to land, so it's quite a unique product. And we have all this learning curve, so we need to run software development. Even if we are using second-hand hardwares, mostly, I'm speaking about the engines and other stuff like this, this one is really hard to recognize here. So mostly what we can do here with all the long-term assets, that in the salvage value, we can assume that we can sell the long-term assets after 5 years, and also the cash reserves, and then we can see that, okay, this is what we can realize here. But otherwise, intangibles, it's really hard to put them into the equation. Okay, but we have these free cash flows for each years, but still we have to estimate their present value. So we need a discount rate. And for discount rate, you can remember from corporate finance classes, you need the weighted average cost of capital, where we can take the shareholders' equity, and so the amount of shareholders' equity, and also the price of the shareholders' equity, so the desired return from shareholders' equity, and the long-term liabilities. So practically debt, amount of debt, and the interest of the debt. And here we can see that we don't have so much debt, nearly at all. So usually the company needs this one to survive, but last time I was lucky when I was designing. Okay, the launch vehicle was quite rubbish because it's too expensive, but otherwise still I was able to survive the first 2 years with profit. So it's a really strange scheme that I was able to follow, so that's why the debt is not significant at all. So in this case, in terms of valuation, practically we should focus only on the shareholders' equity. Okay, but how can we estimate the expected return from the shares? Because this company is not publicly listed right now, so we cannot download past prices of the shares and determine that, okay, how it's changing. So we did estimations. So also what you learned on corporate finance, the capital asset pricing model can be used to at least to estimate what is the price of the equity. So in this case, we need 3 variables. So first of all, we need risk-free interest rate. So we need to take the French 10-year government bond yield, because this is a French company. We can assume it's some sort of French company, so it's located at least in the Eurozone. And why the 10-year government bond yield? Because, bless you, 10-year government bond yields are less volatile. So if we would take the 1 year, obviously everything is annual or annualized interest rate, what we can see here, but 10-year government bond yields are less volatile than the 1 year, because 1 year is much more affected by the liquidity changes, by the monetary policy changes, by inflation changes. So I will show you that what is the problem with those numbers. So that's why it's much more reliable to say that, okay, this can be good enough. Or right now we can also check. If we are going to Refinitiv, and here asset categories, fixed income bonds, government bonds. Zooming in a bit, and France, and currencies. Okay, in this case I'm using zero rates or zero bond rates, because in this case all the underlying interests are combined into the yield curve. So as you can see, this is the main problem. So the short end of the yield curve is completely reacting on inflation changes. So last year when I had to make the case study, it was nearly or really close to zero. And since due to the rising inflation, and now maybe it was reaching the top, so now it's decreasing inflation in the Eurozone, it was reaching 3.4% on the long run. So after 14 years, it's reaching 3.4%, and then after 35 years, then this is going down to 2.8. So we can say that okay, this this curvy thing is also responds to the inflation. This one is now inflation is going down, so the market also tries to react on this one, and that's why if we are saying that okay, let's pick the 10-year government bond yield, it's what is this? 3.2-ish%. So it can be reliable to say that. So this data is from autumn, and you can see that it was just 2.4. So still, we can say that this one is increasing. So 3.178. So we have to update this one. Okay, even if we don't have definitive data, then we can use this free database from a Polish company, and some part of the website is speaking in Polish, some part of the website is speaking in French. Oh, sorry, in English, and we can see that yeah, numbers are quite similar, so we can use any data. Okay, but the other variable what do we need here is stock market index return, and this one is also tricky because we are not able to use year-to-year changes. So we need some long-term returns from the stock market, because otherwise, so the market is too volatile. Maybe it was working in the 60s or not even the 70s, but especially not during the 2010s and now 20s, because from one year to another, sometimes you have a really huge boom, sometimes it's going down. So it would completely misleading the calculation. So that's why it's much more reliable to have a long-term yield or return here from the market. So in this case, the CAC 40 is the main index for us. So we should check the previous values of this index from the last 10 years. So asset classes, equities, indices. Now happily it's back with us. So we need annual data from the last 10 years, and we're just downloading it. So we need some kind of historical return, and from the last 10 years, because after that I think it's unreliable. So going back to 2013, it's reliable because maybe it's a relevant time period for us, but we are not able, so we have to assume that past information is less relevant for us. So it's not good if we are just saying that, oh, let's see annual changes in the data set and just take minus this number minus this number, and then let's just divide it. So what is the ratio of increase, and after that just calculating an average of this kind of variable. It would be completely misleading, because this data from 10 years ago would have the same weight like the data from last year. So we cannot do this because this happened a long time ago, so this information is less relevant. So that's why exponential reduction can be a really efficient tool, because In this case, we're just saying that, okay, this change in the index value can be inflated. So we are just start to multiply it with a lambda value of 0.94 and then on the power of 10. And in this case, we can reduce this number to a really smaller number. And you can ask the question, why 0.94? The reason is because when it was developed, or this exponential smoothing was developed in the 90s by Goldman Sachs, they were saying that for annual data, this is the best fitting number. So in the past, I tried to dig up something, so some kind of validation, why not 0.95 or why not 0.93, but even there is the really strict CHI book, which is containing many proving of different econometrics approaches. It says that this is good in this way. So at this point I was giving up. So we need this threshold of 0.94 for annual data. But as you can see nicely, it starts to recognize the past data with higher weights if we are going forward in time. So
sorry, this value is where did we get this value?
Yeah. So this one, so this value is coming from the French stock market.
We cannot influence that, right?
No. This is generated by the market, and then we are just checking that what is the growth ratio of the or decreasing ratio, because sometimes it was negative in different years, and after that we are just correcting these numbers with the past values here. So as you can see here, in the past data is recognized less, and then this gap narrows down as we are going closer and closer to current days. So at the end of the day, the objective was to see that what is the average growth rate of the stock market in France, and after that we can use this 4.9% growth ratio of the French market, and also their risk-free interest rate to use in the CAPM model. What is still missing? The beta. So if you remember on the CAPM model, so risk-free interest rate plus beta multiplies the difference between the market growth and the risk-free rate, so to see that what kind of premium is provided by the stock market compared to the bond markets. And the beta is required because the beta assumes that, okay, but how the asset is more riskier than the market average. So the covariance of the Aryan space with the French stock market divided by the variance of the French market itself. And in this case, since we don't have such a data, then we can use industrial average. So if we are looking on the launch market, what is the average beta for such companies? And in this case, there is a professor called Damodaran, who is the leading head or pope, or so he's the big figure in corporate valuation and discounted cash flow valuation, and he has a really nice website where he always provides data about this sectoral betas. So this is a public database and we can use it freely, so I'm really happy to have this, because otherwise it would be quite hard. Okay, so data breakdown region. Sorry, current data. I think this one. Yeah, total beta by industry sector. Yeah, so we have different markets. So we got US, Europe, Japan, many other countries, emerging markets, just China, just India, and globally. And right now we just need Europe. So we can download this as an Excel file. And then, as you can see, the date of update was happening in this year's January. So this is a really good database. And then we just have to check for what was that? Oh, sorry, the first one was aerospace defense. So, it doesn't matter that which beta are we using, I'm always using the first one, so 0.9. Well, let's bring the rest of the digits as well. Okay, the beta is now shrinking. If it's less than 1, then it shows us that right now our aerospace business is assumed to be less riskier than the market. If it's bigger than 1, then it's riskier than the market. So it was riskier last year, but now it's less. So, okay, and we can assume that, yeah, but what is the interest of the debt here? And in the profit and loss statement last week we had this, we downloaded this French BBB corporate bond 0 yields, so we can say that okay, let's use this one. We don't want to complicate anything. This is dynamically changing in each year, but practically, since our debt level is ridiculously low, at least in this scenario, then it doesn't matter that it's increasing or decreasing. So we have the weighted average cost of capital for each year, because this one is constant. And obviously this is also a weakness of this kind of evaluation, because if we would have a dynamically changing risk-free rate here, still it would be quite hard to have assumptions about the French stock market performance for the next years. So we can maybe, yes, obviously we can create simulations like we will do it with foreign exchange rates. Yes, we can create some macro models to see, to forecast what can happen there, but at the end of the day, okay, right now let's assume that it's not changing because it's already historical data, what is happening on the market, and also we can see that the beta could also change, but right now everything is constant. At least we need something to start with. Okay, so for each year we just have to use these discount ratios to compute the present value of these future cash flows. And after that, we can be really happy with these numbers, because now we just have to see that, okay, this with this, then it will be providing us the discounted cash flow for the first year, then for the second year, then for the third year, and so on. So it's just also what you learn from corporate finance classes. But still, we have to think about long-term assets. And this is the funny part here, because long-term assets So we have investments, also not disclosed investments, but it's highly irrelevant, so we don't care about that one. Property. Property obviously loses its value as time passes because there is depreciation inside of it. And also we can raise questions about can we sell this property at book value at all on the market or not? Because mostly the property is the launch tower to launch rockets, so the second-hand launch tower market can be quite narrow. So maybe what we can, so the sales price for the launch tower would be scrap metal and the piece of land on it if we would have to sell it on the market, or maybe we can sell it to another company, but usually they're not selling it. So even SpaceX leases the land and the launch tower at Cape Canaveral and also at Vandenberg Air Force Base. So usually they are just creating 20-year or 30-year contracts to rent the area, and until the end of the contract they can build their own facilities and then modify the existing ones. But therefore this property is different if you have a factory or if you have offices, which can be easily or at least tradable on the market easily. When you have this kind of property which is unique, it's hard to define the appropriate value. And the other thing is intangibles. So since this company has many patents at the level of 3D printing, has many patents at the level of software development, has many patents at the level of building different space accessories, how to build different vehicles. That's why some of these intangibles can be sold on the market, or they have the potential to at least sell licenses or sell the know-how, but it can be also questionable. And we can see that these intangibles are quite important. So we are talking about 3.4 billion euros here. So at the end of the day, if you are just looking on the long-term assets, then it can bias everything completely, because we can see that I improved the cash flow generation capability a lot. So let's compare it with the original baseline scenario. When, yeah, so it was highly negative at the beginning. Although it was, at the beginning it was still positive, but after that the company started to go down rapidly, and also the cash flow or cash reserves were negative. But still we can say that the long-term assets are so big, even after depreciation, the intangibles are still there. So at the end of the day, their present value is still positive. So if we are computing all the discounted cash flow together, which is highly negative number, so 1.1 billion minus 1.1 billion euros, but the long-term assets, even after discounting, still can compensate this. So the company value is assumed to be positive, and this can be also tricky. So to be honest, you should somehow deal with. So if it would be a real company, I would dig into the non-financial reporting part and to see that what are these intangibles exactly. Right now we don't have this luxury here, but if you would like to make it more realistic, because yeah, it doesn't matter so much, because at the end of the day the shares are still can be valued, or the company can be valued as 1.7 billion, while after all my changes, okay, it's increasing dramatically, but but the salvage value will be still really important. Okay, I was able to increase the salvage value because cash reserves are added to the game, so that's why this one is also increasing. Just we can still see here that it's 6 million euro now. Okay, so now we can see practically the added value of the business. So if you are implementing your strategy and also you're modifying your own Excel sheets, then all the changes will be added automatically to the valuation. Yes, what you have to do only is to update these numbers and also these numbers here, but I will upload the Excel, so you can do it, and also the beta. Let's highlight what I had done today. So these things were changed. These things were changed. Practically you don't have to change this one because it will, if you are updating this one, then it will recalculate everything and it update that one. So just those things were changing. This is coming directly from the Excel sheet, so you don't have to modify anything. Yeah. So after that, this is the end result. Okay, but let's see the industry.